Good morning, Wall Street. In this video, we're going to classify the decline that the market has had since October of 2007 and see where we are in terms of historical declines that have been similar. Well, the first thing I'm going to demonstrate is that I'm not an artist, but let's just draw a bell curve. And what we're trying to show here is the normal distribution of advances and declines over time. And in a typical bell curve, you're going to find that most of the advances and decline phases fall within the center part of the bell curve. And that as you get further and further out to the right here, you get the larger advance phases that don't happen all that often. And of course, as you get further and further off to the left side, you get the declines that are more pernicious. Fortunately, because they're on the left side of the bell curve, they don't happen all that often. What you don't want to be is all the way to the left. In fact, right there. What that's saying is that when you're looking back in history, you have no frame of reference. It's kind of like the Twilight Zone. We've never been there before. And what I want to show you this morning is that's exactly where we are. We're in the Twilight Zone in terms of how bad this stock market has been. Another way to look at it is how broken is this stock market. And what we're looking at here is probably one of the more infamous patterns in history for the stock market. This is the 1929 crash that didn't really stop until 1932. But here's the thing. The crash began in 1929 with a fairly sizable drop. In fact, this whole decline from intraday high to intraday low was a drop of 49.39%. But then the market bounced off of this low and bounced a little over 50%. And that bounce is what's key for us. This market in the Great Depression was the only one that failed to bounce more than just a 50% retracement of the high to low here. Put it another way, other than the market in 1929 to 1932, all other drops of 40% or more in the market had the market recover back to its highs as a minimum. The only one to do less than that was the Great Depression, where it was only able to bounce back half of what it had declined. So in this table, we've identified all of the biggest drops in the history of the Dow Jones Industrials Average. And as you can see, most of them range between 40 and 50% declines. So in this table, what we've done is identified how long it takes for the market to bounce back to retrace that decline at least 50%. And it varies. You get as many as 366 days. That's the longest it took, and that was back in 1903. For the Great Depression, it was relatively swift. It bounced back in 148 days. The average is around 255 days. But here's the thing. These are the worst drops that we've seen in history. If you take a look at what the market has done in this cycle, with the last 2 trading days, we can now say that the current decline in the market is the worst on record without a bounce. And the interesting thing about this is that in order for this current market to just mirror the bounce that we saw in the Great Depression, the market would have to jump 56% over the next 12 months. That would only put it on a par with the pattern of the Great Depression. This market really needs to double to get back into the middle part of that bell curve. I hope this doesn't ruin your day, but I think that the point that's important here is that few people realize just how historic this current move is. And because we're so far to the left, and that's not a political pun, We're so far to the left on the bell curve that you really need to look at the technicals to help you determine whether a turnaround or a bounce is underway. So far, it's not there. There are a lot of people that are looking for it, that are expecting it, hoping for it, but it's the technicals that are going to tell you when it actually does take place. And we'll be there to point it out. Hope that helps. See you next time.